Today, I'm going to share 10 dividend growth stocks that I think are biased at these levels and lower. Now, these are what we like to call DGIF stocks, dividend growth investing for fire. They're focused on total growth, the growth of the dividend plus growth of the share price. And I use the stock screener to use those DGIF parameters, and I use additional parameters such as PE as well as PEG ratio. Now, all 10 of these stocks fit very well into that screener. 6 of the companies I know very well. The other 4 I don't know quite as well, but I spent some time looking through them, and I want to share all 10 stock ideas. Without further ado, let's get started. Now, the first stock that I want to cover today, this is a fired up wealth favorite. It's Deere and Company, ticker DE. Right now, it's trading around $400 a share, so it's not the cheapest it's been. It was actually down at $283 in the 52-week range, and a lot of the members in Discord were buying this stock at $300 and less. I think Deere is still a buy even at these levels, especially for long-term investors. It's under a 15P ratio at 14.52, dividend yield about 1.27%, and it's a large cap, about $116 billion market cap. You can see it's made a nice bounce here, recent lows around $365. I think this will push above $400 here in coming weeks if the market stays bullish. Now, you have to be careful with all these stocks because we have earnings season coming up, and we could have, volatility in the market. Some of these individual names could miss on earnings and so on. It only has 0.9% short interest, so there's not a lot of people out here betting against DE. On the 52-week performance, it's down about 10%. And I want to cover some quick valuation metrics, but I really want to focus on what this company is all about. This is really a technology company within industrials, within agriculture. Price to sales is 2.13. Price to book is 5.44, but PEG ratio is only 1.06. Now, if you're familiar with PEG ratios, you're trying to find a PEG of 1 or less, which is very hard to do. High quality companies generally trade at a premium, and it's hard to find many that are at 1 or less on that PEG ratio. Next year's estimated PE ratio is about 12.2. And Deere has a very healthy balance sheet. I also want to share some of the numbers from the screener. So again, that dividend yield's about 1.28%. Dividend growth rate, 5-year average, it's sitting at about 15.8%. Revenue growth, 5-year average, 12.9%. Dividend payout ratio, you want this 50% or less. The lower, the better. And this is at 17.41%. And again, the PEG ratio is just over a 1. The PE is under a 15. John Deere's smart industrial strategy will revolutionize agriculture and construction. John Deere will deliver intelligent, connected machines and applications that will revolutionize production systems in agriculture and construction to unlock customer economic value across the life cycles in ways that are sustainable for all. And I've talked about John Deere on the channel before. I've done a deep dive, and I shared with you about a year ago that they hired a chief technology officer, and they're focused on technology and that technology stack. And here are their business units. And Deere really, it's diversified. I mean, they do everything from tractors to lawnmowers, construction, forestry, and more. So full set of technology required to help customers increase their productivity. So autonomy is very first. Automation, machine IQ. We're talking about AI here. Connectivity and digital solutions, guidance, hardware and software. Our technology stack continues to evolve. So they've acquired companies like Bear Flag Robotics. They have autonomous tractors in the works, autonomous drones, and more. You can see they also acquired a company called Blue River Technologies. This is computer vision and machine learning. So this is AI. So they're really focused on the technology, the future of agriculture. Literally tractors that can drive themselves. You can control them with your app on your phone. And Deere has a huge total addressable market, lots of market opportunity for growth in many different segments. And this gives a good snapshot of their different revenue on product lines. So you can see production ag is about 41%. And most of their revenue right now is going to be US and Canada, but you can see they're very international. And this is their R&D spend. Deere is spending a significant amount of money in R&D for technology advancement. And this is in millions of dollars. You can see it's grown significantly since 2008. $6.2 billion net cash flow in 2022. That's impressive. And 57% of cash from operations is returned to shareholders through dividends and buybacks. And here's a chart that shows you the quarterly dividends declared and increased. So it raised 58% since 2020. Deere is one of those perfect DGIF type stocks. If you're looking for compounding, the 8th one of the world, where you buy the stock and hold it for several years, it's going to compound. You let that dividend reinvest. You drip that dividend. You look back in 10 years, this is going to be a monster stock. I have a lot of conviction in John Deere. The ticker is DE. UNH is another fired up wealth favorite. Many members have been buying this stock under $500 in Discord. It trades at about a 23 PE ratio. Dividends about 1.3%. It's a mega cap, about a $471 billion market cap. Some of the metrics from the screener, when you think of UnitedHealth Group, so that dividend yield, again, about 1.3%. Dividend growth rate, 17.08%. That's the 5-year average. Revenue growth over 5 years, you're looking for 10% at a minimum, and this is exactly at 10.01%, just over. Dividend payout ratio, attractive at about 27.39%. PEG ratio is a little bit higher on this one, 1.77. And the PE ratio, again, it's just under a 23. Short interest on this one's only 0.54%. So again, not many people are betting against UNH. Earnings are going to be July 13th, so keep that in mind. 52-week performance, it's down 5.51%. Price to sales ratio 1.41, price to book 5.5. The PE for next year's estimate is 18.0. And of course, UNH is not a hyper growth stock, but it has very consistent numbers. It's one that performs well, whether the market's good, bad, or indifferent. And you could see some pressure on this, especially if we get into a bull market and people start selling names like this to buy growth stocks. But if I'm looking for a high quality company to diversify more into healthcare and insurance, UnitedHealthcare is one of the highest quality companies you can own. It's a very strong balance sheet. Check out ticker UNH. Of course, semiconductors are the new oil, and there will be a few semiconductor companies on this list today. The first one's going to be Microchip Technology. I don't own this stock, but it fits the parameters of that screener very well, and several members in the community do own this. PE ratio is about a 21.76, dividend 1.778%, large cap $44.12 billion. So that dividend growth rate, 5 years, you're looking at 14.55%. Revenue growth over that 5-year period, 14.89%. Dividend payout ratio is just over 31%, and the PEG ratio on this one is 1.58. This one is up 23% in the 52 weeks, so you have to be a little bit careful chasing it, but I think it's still attractive at these prices. Of course, it's going to matter a lot with earnings again coming up. Semiconductors could all sell off. Semiconductors generally the market both ways. So if we have a bull market rip, these are going to continue to go higher. You've seen stocks like Nvidia double from their bottoms and so on. And you can see very solid growth across the board. Some big numbers on this stock. High quality company. So check out Microchip Technology. The ticker is MCHP. So this is one I've covered a couple times on the channel. I've never owned it before, but it has very strong metrics and it always comes up in my screeners. This is Tempur International, so think mattresses. And I know it's a boring stock, but it's a 15P ratio. It pays you a 1.15% dividend. It's a small cap, $6.58 billion market cap. And this is one of those stocks that continues to chug away. It's one you tuck away for 5 or 10 years and you look back and say, wow, I never would have guessed that that stock would have been one of my better dividend stock performers. This is a DJIF stock, and I think it's probably going to go higher with time. And looking at some of those screener metrics, the dividend growth rate 5-year average is actually one of the highest on the list at 40.63%. Revenue growth 12.31%. Dividend payout ratio very low, 16.88%. PEG ratio, this is going to be the third lowest on the list. So out of 10, it's the third lowest. It's under a 1. It's at 0.79. And again, that PE ratio is around a 15. So I won't spend a lot of time on this one. You can research it on your own. Again, it's Tempur International. The ticker is TPX. So this is a transportation and logistics company. It's TFI International. It has a 12.92 PE ratio. Dividend 1.2%. It's a mid cap, about $10 billion market cap. Short interest is under 1%. Some of those additional screener metrics for TFII. So dividend growth rate's a little bit lower on this. The 5-year average is 10.76%, but still over that 10% we're looking for. Revenue growth is a little bit better. It's at 19.25% on 5-year. Dividend payout ratio, again, very low on this one, 15.47%. And the PEG ratio is only at 0.67. The company operates through package and courier, less than truckload or LTL, truckload TL, and logistics segments. As of December 31st, 2022, company had 11,442 tractors, 38,091 trailers, and 6,905 independent contractors. The company was formerly known as Transforce Inc. and changed its name to TFI International in December 2016. This is headquartered in Canada. So check this one out. The ticker is TFII. This is the most expensive stock on the list of 10, but it might be the most popular as well. ASML Holdings. Now, Now, I like this stock a lot better below $600, but if you're looking for a long-term investment, this is still attractive. It is a 42 PE ratio, so it's going to be the most expensive one again this list. Pays you about a 1.55% dividend yield. It's a mega cap, $252 billion. Some of those additional metrics, very strong. So 31.64% dividend growth rate in that 5-year. Revenue growth, 15.77%. Dividend payout ratio is 33%. PEG ratio is 1.55. So even though the PE ratio is 42, that PEG ratio isn't that bad. And if you're not familiar with ASML, they develop, produce, market, sell advanced semiconductor equipment systems. So this is a semiconductor equipment manufacturer focused really on lithography. Think of EUV systems. The company was founded in 1984 and it's headquartered in the Netherlands. Now be aware, earnings are April 19th. That's tomorrow. So you might be watching this video and earnings might have already even happened. The stock could certainly sell off or it could go higher depending on what the earnings say. Macro is always going to be obviously most important, especially in the short term. So you could see it pop or drop. If this stock gets closer to $600 or less, in my opinion, that's the area where you'd want to buy, unless there's something catastrophic on the earnings report that maybe scares you away from it. So we already covered UNH, but I also want to cover Cigna Group, ticker CI. So Cigna is another healthcare play, and it deals again with insurance and related products and services in the United States. P ratio is a 12.1, dividend 1.9%, large cap $76.83 billion market cap. Short interest is 1.07%. Some of those additional metrics, now listen to this. Dividend growth rate, 5-year average, according to the screener and Fidelity, 161.81%. Revenue growth, 34.05%. Sometimes the most boring companies, you think of healthcare and insurance, I don't want to own that. Sometimes they're the best performers. Dividend payout ratio, 28.57%. PEG ratio, very attractive, 1.07. Again, PE ratio around 12. So check out Cigna Group, ticker is CI. Now I've got 3 more stocks to cover, but before I go on, I need to announce this video is sponsored by the Motley Fool. If you'd like to see the 10 best stocks to buy now, visit fool.com/firedupwealth. A reminder, Motley Fool doesn't tell me what to make, what stocks to cover. They're a great partner and they allow me to bring content like this for free to you on YouTube. So check those guys out. You can also join our private community in Discord. Visit patreon.com/firedupwealth. We have created the best Discord community for investing on the planet, and I encourage you to join us. Also, I'm trying to grow this channel to over 40,000 subscribers in 2023, and you can help me out by subscribing now and clicking that bell for notifications. And if these videos are helpful, drop me a like and drop me a comment. Help me get in the algorithm so we can get more subscribers and grow the community and do even more videos for you. Now, another semiconductor company, and I like this stock a lot, especially 110 or less, especially if it gets $100 or less. Now, I've had this in Discord on the watch list for 110 or less as an area to start dollar cost averaging. I used to own this stock. I don't currently own it. It's a 15 P ratio, 1.145% dividend yield, large cap, $94.48 billion market cap. Short interest is 1.81%. Now, the 52-week range on this, 71.12 to 125. So $71 would have been a heck of a buy, like a lot of stocks right now. But when you look at some of these metrics, still very healthy. And Applied Materials is starting to branch out into other areas, such as that EUV lithography that ASML focuses on. I think both companies will do well long term. And really, when you think of Applied Materials, it's just a small segment. We don't have time to go into that too deep right now. But some of those other metrics from the screener, that 5-year dividend growth, about 26%, revenue growth, about 12.14%, dividend payout ratio is very low, 12.81%. PEG ratio, 1.15. Again, the PE ratio around 15. Now, all these companies are very attractive. They're obviously profitable. They're paying dividends. They have strong balance sheets for the most part. And these semiconductor companies really stick out. I look at Applied Materials. If I've owned this for 5 or 10 years, it's probably going to outperform the market and I'm probably going to be very happy. But remember, these are not hyper growth stocks, right? These are dividend growth investing stocks, DGIF stocks. And I have covered this on the channel before as well. This is VAC, Marriott Vacations Worldwide. 7 iconic brands, 120 resorts, 700,000 plus owner families, leader in upscale resorts. When you look at the news right now, you look at what's going on with travel. United plans to expand Australia and New Zealand flights 40% and bet on international travel rebound. Travel is still in high demand. My wife and I haven't taken a vacation, really an international vacation, since before the pandemic pandemic. And there's still a lot of people that have that on their bucket list to check off their list, right? You guys want to go on vacation, go international. And this is going after really a high-end market here. You look at this 735 FICO score, median net worth $1.5 million. And in a recession, this type of customer base doesn't really get impacted the same way as everybody else, right? Strong liquidity position. They've got $266 million cash on hand. Real quick on the metrics here. So you're looking at dividend growth, 12.47%. That dividend yields 2.1%. Revenue growth 5-year about 19%. Dividend payout ratio 27%. PEG ratio is only a 0.41. And again, that PE ratio is just under 16. One more semiconductor company to cover. Now this was $76 on that 52-week low, and it's at 109 right now. I'd like to see it come back maybe closer to 100 or less. This is Skyworks Solutions, 15 PE ratio, 2.24% dividend yield, mid cap $17.6 billion. Now, of course, this company has been impacted maybe more than others because of their focus. You think of smartphones, you think of gaming, and so on. This company will do well longer term, and it's one of many high-quality semiconductor companies that you can buy that are attractive in terms of valuation as well as dividend and growth. Some of the metrics on this, 14% dividend growth 5-year. The revenue growth is actually one of the lower ones on here. It's the lowest actually, 8.48%. So it's just under that 10% minimum that we want. Dividend payout ratio is 32%. PEG ratio though is a 1.01, very attractive. I think there's a good chance if we get into a bull market run that revenue growth will start to expand as well. And that's why I've included Skyworks as the 10th pick on the list. I hope this was helpful, guys. If it was, make sure you subscribe to the channel, click that bell for notifications, drop a like, drop a comment. Have a great rest of your day. Take care.